Good afternoon, everyone. I'm Bagger Don at Stock Market Caddy. Today is Wednesday, October 23rd at about 1:40. And yes, the markets are turning down. I hope it did not catch you by surprise. It should not have caught our members by surprise because we were cautioning them for the last few days, at least. On Monday of this week, we placed a put option on the S&P, a single put option with an expiration of December 6th, a strike price of 58.50. It had 46 days. It only has 44 days now. The cost of that put option was $10,880. If we were to close that out today, we'd realize about 30% or about $3,000. We're not about to close it at all. We're going to sit on that. We also, at the same time, as an example, put on a vertical call credit spread. We sold a 58.50 and we bought a 60.40. Same length of time. The payouts will be different. The maximum profit that we can make is close to 9,000. We've already, if we were to close it now, we'd realize about 1,600. We're not going to close that out either. When you put on a put, the probability of profit, not the probability of outcome, the probability of profit is 33%. Now, because we're using machinery and our tools, our probability of outcome is much higher. Quite frankly, I'm not putting on a put on the S&P unless I think I got a pretty good shot of doubling my money, maybe more, and I still think that's the case. When you do a call credit spread, the probability of profit, not the probability of outcome, the probability of profit is 66%. You won't make as much money, but you'll do very well. And when you're using our tools, not only do we have a good opportunity, a probability of profit of 66%, but the probability of outcome is also going to be much higher than normal. Because you see, folks, we understand the math behind options, and we're putting that math to work in our favor. I hope you'll stay with us for the next few minutes because I recorded on Monday these trades going in, why we were putting them on, and how we put them on. Feel free to take a look. Be sure to visit our website, stockmarketcaddy.com. Send us your questions and explore. We're not handing out the fish, but we are mentoring folks on how to fish. If you want to learn to trade futures intraday, mechanically, robotically, getting away from the emotions of fear and greed, and you really want to put the math behind options in your corner, then you definitely want to give us a shout. I can be reached any day, 9 a.m. to 9 p.m. at 813-758-8263. Now I'm going to play for you Monday's activity when we place these trades. Have fun, everyone. Okay, at last night's video, and I'm making this video for all of our members, everybody, monthly and annual members. Last night we mentioned how we felt that the S&P in particular is showing divergence. And let's go in here and take a look at the daily. The daily on Swing Machine is pushing 70. Let's put the VIX up on a daily. And we got the VIX at 40. So if they were in proportion, we should be down in here. So we're thinking that this market is stretched and wanting to come back. So what I want to do is I want to put on a two different styles of option trades. And let me open up the option manager, Option Station Pro at TradeStation. We're going to open this up. And Darian, I see you. We're going to be chatting in a moment, but I thought I'd open up your microphone so you could see this as well. And so Darian's getting to see this real time. But I want to get this these trades in. And now these are our demonstration and of what's possible. So what we have here is the SPXW. This is the big boy S&P, and I want to go out about, I want to take us through the election. I want to take us out about 46 days. So this is the weekly S&P. Now, if you want to scale your options down, you don't have to use the big boy S&P. You can use the SPY, the SPY, which is 1/10 the size. Therefore, the cost and everything would be 1/10 the size. What we're going to do is, let me expand this. We're going to put on a put option. So I'm going to scroll this down. It goes out 46 days. We're trading at 58.48. So I want 58.50. The cost of this is $10,000. We're going to buy it. We're going to buy a put. We're only going to get one. We're going to buy one put. It expires, this contract expires on December 6th. The strike is 58.50. The max profit is 574,000. That's not likely. That would be the S&P went to zero, and that would be the end of the world as we know it. So not likely. The maximum loss is 10,580. If we continue to run, then yes, we could lose that. We're going to manage it so that if we lose half of this, we'll close it. If we lose half of the time, which is what, some 45 days, we will also close it. As an example though, if the S&P during this period falls 10%, bringing it down to like 5,400, this option would be worth about $40,000 or $50,000. Let's place the as a market. You would want to place it as a limit. Going to place the order, and order rejected. Why did it reject? You little stinker. Let's see what happened. This for the benefit of everybody. All right, so we the order did not go through. We're going to go back in, and we're trading at 58.42, and we're going to get a 58.50. We're going to buy, and we're going to get just one. Oops, just one. It is a put, a market, and we're going to place order. And the order's in. Now, that's one way to go. Now, the probability, not the probability of outcome, but the probability of profit is about 33%. If I want to increase the probability to 66%, what I would do, and what I wanted to get on video this morning, and we're going to let these play out, is I could sell a call credit spread. Won't make as much money, but also won't risk as much either. And I have the probability of profit. So I'm going to go to the same date. I'll try to do this. Go to December 6th so they can compete with each other. And rather than buying a put, I'm going to sell a call. And I'm going to sell that one. And now when I sell a call here, it's a short position. I don't want 6 of them. I want just one of them. Oops. And it shows me that my max profit is 13,400. But my max loss is infinity. So that wouldn't be a good thing. And so what we want to do is take a portion of our profits from selling the call at 58.50, and we're going to buy ourselves a call up higher. 58. I'm going to need more strikes. We're going to get 30 strikes. So it's we're trading at bear with me. There they are. So I want to come up 58.50. I'm thinking 59 to protect myself. 59. Let's come up. Let's see. We're going to use the delta. We're at 58.50. The delta is at 55. I'm going to come all the way down, and let's see, we got some more strikes. I want more strikes. We'll go with 40. I'm going to use the delta. So this is us here. We just sold a call. The delta is 55. I'm going to buy a call higher that is going to hedge this, and I'm going to come down and I'm going to do it at 0.32, which is 6,000. Let me get a few more strikes. Okay, we'll go ahead and put this on all. And let's go get them again so we get more strikes. So I want to get 60-30. Right at the likelihood that that's going to go up there, I'm going to put it right here at 60-40. So we sold the call, and now I'm going to push this down, and I'm going to buy a call right here. I'm going to buy this 60-40. And there it is, and I just want one. So now what we have is, it didn't refresh. So I'm going to change the dates here to refresh this a month, and then I'll put this back. There it is. So this is a spread. We sold a call for December 6th at 58.50, and our risk was infinity, and we received a premium. Now what we've done is buy a call on the same date. We used the delta to decide where to do it. We went upstream to protect, and we bought a call, which is a long position. So now our max profit is 9,000, and our max loss is 98. We'll review this in more detail, but we're going to place this, and it should be placed in with a limit. I'm going to place it in a market because I need it to go in, and this is in our sim account for it to demonstrate. But Susie's got this on her desk, so these orders actually may get placed. And now I'm going to come here, and there's the put that we put on earlier, and I'm going to hold this down and drop it on top of that one, and that is an example, very quick one, of a vertical call credit spread. Now the put, the probability of profit is 33%, but it will be huge profit if we get a 10% correction, if we do get it, a big one. So we could make a lot more money. I would have preferred to put it on if it was in Euphoria, but it wasn't quite there. But I do want to get it on. The vertical, the probability of profit is 66%, but we don't make as much. The most we can make is about 9,000. So we're going to let the two of them compete with themselves. So I wanted to get these placed. We're going to save this video, and we may narrate it a little bit more detailed for everybody to see. And we're going to minimize that and catch up with Darian. And there are the positions, which we don't need to watch those. The position bar graph, by the way, you can program that to or customize that to show you your options or just show you your futures.